For being such a worthless, barbaric, and archaic relic, it's quite impressive how many headlines and stories and how much attention gold receives on a global scale. Whether it's governments, financial institutions, financial writers, gold, and silver for that matter, are really dominating some of the headlines, and there's a lot of stories, a lot of information pouring over the wires right now. So let's choose some of them apart. We're going to take a look at what the chatter is out there, try to get an idea of what's going on around the world. There's a lot of information to really sort through and come up with, formulate a conversation here on the channel on what we think as a community gold and silver look like they're going to do going into the next few years. So let's get right into these headlines and see where these metals are and what's going on. Gold trades to new lows, silver stays stubbornly strong. We've seen gold take quite a beating ever since the election, while silver holding its own, doing pretty well. Gold continuing to drop while silver prices hold. We've got that Fed meeting coming up. We're going to see, and we'll get into that, but we'll see. It's going to be very interesting to see what happens after Wednesday, especially once it sounds like, looks like, rumor is, interest rates are going to see a rise here, a little bit of a hike coming out of the Fed, but who knows? Gold continues to fall to its worst level since February. Silver stubbornly failing to follow the yellow counterpart. Silver's performing pretty strong. A lot of that might be due to, like I've said in the past, that its ties to industrial applications and some of the manufacturing, defense contracts, all those different things that silver is really known for. When the economy's humming along pretty good, manufacturing, industrial applications, and all that, silver finds its way into so many different goods that are manufactured and created, whether it's defense products or consumer products. I think that's one of the big driving points that keeps silver prices where they're at, which is good for silver, good for you guys that are heavily weighted in silver. And as I just mentioned, heads up, we got that rate decision on Wednesday. Rumor is 25 basis point increase to 0.75% from the 0.5% currently expected. The policy statement and the Fed's economic projections and rate path expectations will be a primary focus for the market. Expect heightened volatility following. It's going to be interesting to see how the markets react. Housing, I've been looking at that a little bit because there's a lot of anticipation for the interest rates. And so housing interest rates and mortgage loans here in the States anyway are seeing the sales of homes is kind of slowing down because of the increase in the mortgage interest rates. Central bank gold demand could accelerate on growing federal debt. Inflation can be understood as the destruction of a currency's purchasing power. To combat this, investors, central banks, and families have historically stored a portion of their wealth in gold. I call this the fear trade. The fear trade continues to be a rational strategy since President-elect Donald Trump's surprise win a month ago. The Turkish lira has plunged against the strengthening U.S. dollar, prompting President Recep Erdogan to urge businesses, citizens, and institutions to convert all foreign exchange into either the lira or gold, most obliged out of patriotism, including the Borsa Istanbul, Turkey's stock exchange. And the move has helped support the currency from falling further. Shortly thereafter, we saw multiple explosions and a violent activity outbreak in Istanbul. Some are questioning what caused that, who performed those acts and those agitations, because the timing of such violence is always questionable in the Middle East. As soon as a country seems to renounce the West or the U.S. dollar and start speaking of gold, well, it seems like those countries are quickly thereafter destabilized and erupt in violence. So you can come to your own conclusions with that, looking at Tunisia, Libya, Egypt, Iraq, Iran. I mean, the story goes on and on. It's a pretty impressive script, whoever writes it. Gold save the Turkish lira. Here you go. There's a little chart there. President Erdogan urged citizens to convert foreign currency into gold. right about there. Not a bad move to convert any paper currency into gold. Venezuela, meanwhile, has dire inflationary problems of its own. Out of control socialism has led to an extreme case of demand pull inflation, economists' term for when demand far outpaces supply. Indeed, the South American country's food and medicine crisis has only worsened since Hugo Chavez's autocratic regime and the collapse in oil prices. The bolivar is now so worthless, many shopkeepers don't even bother counting it. As Bloomberg reports, instead they literally weigh bricks of bolivar notes on scales. And we've covered this story just recently in two separate videos where we discussed and touched on the crisis in Venezuela. Central bank demand could accelerate on growing federal debt. The U.S. government is currently saddled with $19.9 trillion in public debt. Since 2008, federal debt growth has exceeded gross domestic product growth. And according to a Credit Suisse report this week, Trump's tax proposal, coupled with deficit spending, could cause federal debt to grow even faster than under current policy. And we've touched on that as well. It's very likely that some of the policies implemented by the new president-elect could accelerate U.S. deficit spending, and the U.S. debt will do nothing but increase, which in the long run will firm up and actually increase the valuation in gold as it is denominated in U.S. Federal Reserve notes, fiat paper. The amount of paper it takes to buy an ounce of gold will increase. That I am certain of. After analyzing projections from a number of agencies and think tanks, Credit Suisse estimates a federal debt to GDP of 92% by 2026, including a GDP growth offset from the lower tax tailwind and 107% excluding the GDP growth offset. Higher U.S. budget deficits and debt could spur central banks to increase gold buying. Almost certain of it. Central banks are going to, they already are entering the game again. They've become big players in it. And regardless of what you read and what you're told, they will be and continue to be the largest holders of gold in the world. It's their job. It's what they do. They protect their money. They hold all the real money, and that real money is gold. The U.S. dollar accounts for about 64% of central banks' foreign exchange reserves, with the potential for higher U.S. budget deficits and debt-risking dollar strength. Central banks around the globe could be motivated to increase their gold holdings, says Credit Suisse. That's a pretty strong case looking into the future for major moves towards gold by central banks. And that's just one article, just a few highlighted points. There's also much more to it, much more out there information that corroborates that very viewpoint that we just touched on. From hot to not, investors exit gold and switch to equities. So we're looking at both sides here, looking at some things going on. I think you're going to see here a pattern. The little weak bird people, these investors that we're going to speak of course, they run around. They don't know which way to go. They're like, well, we've talked about them before. They panic. They panic very easily, and they like to run in herds like lemmings off of cliffs. So here we go. You want to be that guy in the crowd that goes the opposite way. So look at what these guys are doing, and we're not going to do that. From hot to not, investors exit gold and switch to equities. We've been seeing this behavior recently as they overreact. Over the past month, exchange-traded funds backed by precious metals saw a net outflow of $6.31 billion as gold prices tumbled to a 10-month low, according to data compiled by Bloomberg. As the money exited, ETFs tied to equity markets saw an inflow of $76.2 billion, helping to send the S&P 500 index to an all-time high. We're also seeing the Dow at an all-time high. A lot of gold got sold and got put into these other markets. Investors have already withdrawn about a quarter of the more than $12 billion that they poured into SPDR Gold in the first half when bullion prices touched a 2-year high. In November, the ETF had the biggest monthly outflow since May 2013 when gold was languishing in a bear market. The sell-off in gold was a little bit too violent and too short-sighted, said Chad Morganlander, a money manager at Stifel, Nicolaus and Company in Florham Park, New Jersey, where he helps oversee about $172 billion. The fund hasn't paired its positions in SPDR Gold, he said. We're expecting gold to start to move higher over the course of the next 6 to 12 months as interest rates stay anchored below expectations. So here's a firm, they're holding their position on gold while a lot of others panicked. So you can see not all investors and money managers are running with the crowd. Some are staying put. And I think it's the guys that might be a little bit more rational, a little bit more calm. We'll see. We'll see where this ends up. But none of us here on the channel manage this type of capital. So we're not even peanuts. We're not even crumbs. We handle molecules compared to these people. Let's swing over to China. Take a look over there. China gold premiums soar amid import limits. So we got some governments passing some legislation. We're seeing some things take place globally. We're going to look at China. We're going to look at India real quick. Gold premiums in China, the top consumer of the metal, held near 3-year highs this week amid short supply due to Beijing's decision to restrict imports of the precious metal in an attempt to prevent capital from leaving the country. Gosh, you gotta love governments. As the yuan dropped to the lowest level since the financial crisis of 2008-2009 and declined close to 6% so far this year, Beijing has been weighing measures to reduce outflows. One of them is placing tighter quotas on imports of the precious metal, which has pushed Chinese gold prices higher than international spot benchmark by as much as $46 per ounce, compared to normal levels of just $3 per ounce. And now remember, these must be for big trade bars or something, because I don't know anywhere you can get gold for $3 per ounce over spot. I've never even seen gold for that, other than if you were buying a 400 ounce London Good Delivery bar or something like that, which I've never even seen one of those in person, let alone touched one, smelled one, handled one. So these are levels of gold that are beyond you and I. China gold premiums hold near 3-year high. Cash crunch curbs Indian demand. Gold to rocket after second rate hike. Here's why. This is another interesting look at a prediction of how gold is going to react going into the near future. We'll take a look at a chart here. Percent mining share of global market cap. Inflation. Interest rates are rising since the Fed and the government see inflation starting to recede from historical lows. And with the proposed infrastructure plans, other construction metals have already began trading higher. What's paramount to understand is that rates rise, but so does inflation. So real rates remain low and even negative. In fact, Goldman Sachs turned bullish on commodities for the first time in years. Tightening periods versus gold. Contrary to what mainstream media is feeding the average investor, here's what historically has happened during the first and second rate hikes. So you can see periods in gray there, the 3 largest Federal Reserve rate hike cycles since 1971. Until today, there have only been 3 clear periods of rising rates. This we're going into will likely be the 4th. Federal funds rate and percentage change of gold and the S&P 500 during 1972-73 Federal Reserve rate hike cycle. As you can see, tightening periods aren't favorable for the S&P 500 as interest rates act as a weight on stock prices. So there you can see the Fed rate rising, and then you also see gold rising, and then you see the S&P price drop. But it was the second rate hike period that caught investors unprepared. Between January 1977 and April of 1980, the Fed funds rate increased by a total of 1,300 basis points from 4.61 to a high of 17.61. During this cycle, the price of gold increased from $129.75 to a high of $850, a gain of 555.11%. Gold gained 46-fold more than the S&P 500. And I'm going to interject that a lot of that, I believe, is due to the fact that gold had just become legalized. Markets and investors were not yet used to owning legal gold here in the United States. 1974, that's when you were finally able to invest and purchase, gold bullion. The author writes that speaking with Canadian fund managers, I can say that gold is underweighted in their portfolios. Most Canadian pension funds are 2% weighted in gold stocks, and the TSX index is 8%. And this is going to continue until gold goes to new levels. There's a whole surge of buying frenzy that hasn't even scratched the surface. He also mentions up that the thing nobody seems to mention is annual gold production. And we're hearing this talk of peak production, peak gold. And there's predictions there that we reached it last year, and that from this point forward we will see a reduction in the amount of gold produced and mined. There's currently 90 million ounces mined annually, but only 40 million are being discovered. That's a 55% gap that's not coming back. So we're seeing a decline in how much gold is most likely going to be discovered and mined and brought what they term above ground. Now, my favorite part and the strongest part the author of this article makes towards gold's performance going into the future is the link to war spending. Historically, going back since the time governments first existed, since the times of Charlemagne and the Roman Empire and earlier, it takes gold to fund war. Any government, any state, in order to pay soldiers, to buy equipment, and to wage violence, state-sponsored violence, you have to have gold. So the long-term picture is very bullish, and I am personally making big moves to position. Here he says, Obama will be the first president to be at war for 2 full terms, and war spending is set to increase. Gold prices respond to increased war spending and federal budget deficits. So here you can see war spending, $209 billion, $1.1 trillion, $333 billion. Additions to the deficit, you can see a change in gold price there, 120%, 260%, and then a reduction down by 28% there. But still, very much above those earlier levels in the earlier years there. Gold's still above there. Now, the explosion in deficit spending derived by war costs absolutely decimated the US dollar from 2001 to 2012. But it was a clear reason to own gold, and part of the reason it rose higher. In 2013, budget reductions in military spending was what he says caused gold to stabilize. It was probably one of the reasons, among others. It's now becoming increasingly clear that the top echelon of generals are requesting funds increase again because equipment needs to be bought and soldiers are unprepared. Bloomberg just published an investigative article on this and learned that servicemen and women are literally dying because of the corners being cut to keep aged equipment in service. So if we see the U.S. military start increasing their spending here, money has to come from somewhere, deficit spending, the debt, and of course that's going to correlate into a revaluation of the gold price and increase in the value of gold. Gold is the ultimate form of money and the only type of money that governments cannot print. It is a core holding of the sound investor, and contrary to what most expect, being a contrarian will again be the place to be. And this came from Daniel Amaduri for the Gold Report. He's the founder of the Wealth Research Group and has quite an extensive resume. If you find the website in his bio, you can go ahead and read more of that there. But thank you, Daniel, for the information. Venturing back, taking a look at some news that broke this morning, a little bit of an update there in the India situation. India's top gold import bank suspends bullion dealers' accounts. India's top importer of gold has suspended the bank accounts of some bullion dealers and jewelers after 2 of its executives at a branch were arrested over alleged money laundering. The move is likely to curtail imports by the world's second biggest gold consumer this month and could weigh on global prices already near their lowest levels in 10 months. So this is definitely a reason we're going to see some suppression, artificial suppression of gold demand is what I would call it, because this is a beach ball held underwater. As soon as they relinquish these controls and then return to allowing Indians to buy gold, a lot of pent up currency and angst will be released, and they will purchase large quantities of gold, driving the price higher. Again, this is a reason why the current prices and dips in gold are very much temporary. Okay, back to the article. We have temporarily suspended transactions and a few current accounts as a part of a larger, enhanced due diligence exercise being conducted on transactions post demonetization, the bank said in an email reply to questions from Reuters. Prime Minister Narendra Modi scrapped 500 rupee and 1,000 rupee banknotes on November 8th in a bid to flush out cash earned through illegal activities or earned legally but never disclosed to tax authorities. Here's the government's once again trying to get theirs. It is estimated that 1/3 of India's annual demand for around 800 tons is paid for in black money, the local term for untaxed funds held in cash by citizens that do not appear in any official accounts. Again, we talked about this. We've covered this story. This is all about governments trying to get tax money and having their fingers in the cookie jar and getting their cut, reaching their hand silently into your back pocket and pulling out a little bit of money for themselves. UK investors flock to fintech firm Bullion Vault as gold prices soar. London fintech group Bullion Vault attracted a 90% increase in UK gold investors this year and saw annual trading volumes increase by more than a quarter. Market volatility and uncertainty surrounding the EU referendum in June and ahead of the US election in November led gold and silver prices to soar, contributing to a trading volume increase of more than 28% to 689 million pounds. Bullion Vault said in unaudited results, an average of 5,000 deals per week were completed on the platform. Bullion Vault, which is a platform for physical gold and silver trading that launched in 2005, grew 43% in the year ending October 31, reaching 5.6 million pounds in turnover, up 12% to 420 million pounds. Chief Executive Robert Glynn said, with gold price easing back since Donald Trump's election, this year's jump in precious metals investing has grown again. Risk events such as the French and German elections look likely to shake financial markets still further in 2017. The ability to trade bullion at weekends or overnight when stock markets and traditional dealers are shut may prove as important as it did on June's Brexit result. In our increasingly competitive market, private investors continue to choose Bullion Vault for simple, secure, and low-cost access to physical gold and silver 24/7 online. The 2016 financial year was Bullion Vault's heaviest for net demand since 2012 for both gold and silver, the group said. Customers have since added more than 3/4 of a ton of physical gold in November alone, the strongest month for net demand since the global financial crisis peaked in November 2011. So it looks like you Brits are staying on the game, staying on the ball here, really purchasing some metals, even breaking records up until right now. The strongest buying since the collapse, since the peak of the financial crisis in 2011. And let's take a look back on a story we've touched on several times. Case closed, the fact of bullion bank gold and silver price manipulation. So we talked about the whole Deutsche Bank scenario, and there's some interesting news out there. You can actually read exchanges, and I've got two little funny exchanges here between people who were caught. But back in April, the cartel shills and apologists attempted to minimize the news that a settlement had been reached regarding a nuisance lawsuit alleging price rigging in gold and silver. As we told you at the time and on many occasions since, this case is instead quite significant and very important. The latest update on the case released late yesterday sheds more light upon what we've always known was taking place behind the scenes in the free and fair precious metals market, unquote. First, just another reminder of the two key points. Because of Deutsche Bank's settlement offer and willingness to turn, quote, state's evidence, unquote, in the case, for the very first time, a civil lawsuit regarding gold and or silver price manipulation is being allowed to move forward into the legal discovery phase. This means depositions, affidavits, and subpoenas. Never before has a case been allowed into this phase, as all previous civil suits were thrown out by bank-favored judges before discovery could begin. 2. With Deutsche Bank now having agreed to nearly $100 million in settlements in the case, there is now the proverbial blood in the water for every class action attorney in the world. This current lawsuit is just one case, and this Deutsche Bank settlement is just one small part of it. There will now be countless new lawsuits filed, each of them seeking damages from the bullion banks for the now discovered and proven collusion and manipulation of precious metals prices. Potential claimants range from mining companies to shareholders to day traders to investors / stackers. So how many of you plan on getting in on this lawsuit? From the Zero Hedge article, here are two text exchanges that have been unearthed and submitted only because of the Deutsche Bank cooperation and legal discovery. There will be many, many more of them. Of that you can be certain. So read through this one here. You can just see it. May 11th, 2011. From Trader B. The fix, dude. You guys were the silver market. Trader A. Why you say that? Trader B. Haha, on the fixes. Trader A. Someone told you? Question mark. Trader B. And I don't understand that. My LDN. Trader A. Ah, okay. Trader B. You guys short some funky options. Trader B. Well, you told me to, but I told no one. You just said you sold on fix. Trader A. We smashed it good. Trader B. Expletive. Hell. UBS. Now you make me regret not joining. Trader A. By the way, keep it to yourself. And here's one from June 8th, 2011. Trader A. And if you have stops, ... Trader A. Oh boy. Trader B. Haha. Who you gonna call? Stop busters. Of course he ends with haha. So it's a joke to them. It's a joke. These guys are laughing. These big money managers, these guys moving capital around, manipulating metal prices. It's a big joke to them. Consequences of which it does not seem they were too caring of. As an aside note, the date of the exchanges posted above, May and June of 2011. After reviewing this evidence of direct collusion between the bullion banks, do you have any remaining doubt as to the origin of the trades in the May Day massacre of Sunday, May 1st, 2011? That sudden $6 drop in silver brought an abrupt end to the cartel short squeeze that had pushed silver from $38 to $48 in April of that year. What followed were 5 CME margin hikes in 9 days, and silver falling to $38 in days and $26 within weeks. Again, after reading the text messages above, you now know precisely how this was accomplished. Others are calling this Deutsche Bank's smoking gun evidence to expand U.S. silver rigging case. Lawyers for investors accusing several major banks of conspiring to rig silver prices are seeking to add 5 new defendants to the case, based on what they call, quote, smoking gun, evidence they obtained from Deutsche Bank following a settlement. Now they're looking at Barclays, Bank of America, Standard Chartered, BNP Paribas. I mean, we've got, this is a lot of fallout coming out of this, and for years, it might hurt some of you because, for years, people out there in the stacking community were aware of some misbehavior going on behind the scenes, but you couldn't really prove it, and now it's somewhat coming to light. We'll see how far it goes. We'll see if anything actually... Very doubtful heads are going to roll with this. This is one of those things, you keep an eye on it, and my wager is it's going to be swept under the carpet, and this isn't going to go very far. That's just my wager from experience in the past. Unfortunately, these banks, these individuals, are too powerful. They have their fingers in too many places, and they are the puppet masters. They control many of the suits in Washington, many of the judges that would ever hear their case. So don't expect justice. Before we close out, after looking at all those headlines and all the things taking place around the world regarding gold and silver, had a couple of little reading materials here that some of you might find interesting if you're into that sort of thing. There's an article titled Critique of Mainstream Austrian Economics. Pretty long. It's not even an article, it's more of a paper. In spirit of Karl Menger, an analysis of some aspects of the economics of Ludwig von Mises. Now, this is from Professor Antal Fouquet, professorfouquet.com. If you get a chance there and click on some of his links, that article has a very good portion of it about the 100% gold standard and facts pertaining to that, and some of the opinion that Professor Fouquet offers in managing a gold standard, how it would work, and his ideas for one. So go ahead and take a look at that article. Another bit of reading material I think many of you would find enjoyable. I have not yet read it, but it does sound intriguing, and I do enjoy a lot of the writings and opinions of this author, James Rickards. The New Case for Gold by James Rickards, New York Times best-selling author of The Death of Money. This New Case for Gold sounds like he outlines a lot of different points and a lot of his opinions that we've heard over the years now collected in one book as a case for gold. And I'm glad to see books like this hitting the shelves out there. That about wraps up today's conversation, topics, and headlines. And regardless of your feelings on gold, you have to admit one thing. It sure does generate a lot of conversation, doesn't it? Volumes of headlines, articles, news productions. Around the world, it's discussed, legislated, managed, argued over, fought over. It really is incredible. Just this chunk of metal, this inert, rare material. And here we are talking about it once again. Headlines generated around the world, and governments scrabbling over documents and legislation. Funds, traders, investors lying, manipulating facts. All of it so that somebody somewhere can attain more gold and hold more gold in a vault. Pretty darn incredible. Well, there you go. There you have it. Thanks for tuning in once again to Fake News here on the Junius Maltby channel, where we take fake news to the most boring level. I hope you had a good boring time here, and have a Merry Christmas, Happy Holidays to all of you. Be well and healthy going into the new year as it approaches. Quick update on the coin. We just broke $1,300 in donations for the dies to be manufactured. We're closing in on it. There's light at the end of the tunnel, and I expect that we will have the dies produced and coins available for order sometime. We're looking at most likely late January or early February. I'm guessing February is going to be the month where you're going to see these coins for the channel up on QSB Quality Silver Bullion's website. So pay attention to that. Keep that in the back of your head. Save your Christmas money you get from your grandma in your little envelope. And I look forward to bringing these coins to full production and able to be ordered by all of you out there on the Junius Maltby channel. Thanks for tuning in once again.